this year. Get into the flow of capital, get your soup ladle down in there and extract usable money from the deep layers of liquidity that function in the economy. Hey guys, good morning. And we are now January 2nd, something like that, the new year. And already tech companies are dropping. Why are so many tech companies dropping so quickly? I'm going to get into here, but this is a really important episode to listen to if you care about money. As I ended up last year with this thesis of the deep economy, that is where there is a flow of liquidity or a flow of capital that you can tap into if you have the tools to do it. This brief overview today is going to run you through an example. So lots of people talk about the economy or raising money or pitching or whatever it is in a very abstract way. I am currently raising a lot of capital for a big project that's going public. We'll cover how I'm doing it, why I'm doing it, where I'm doing it. You can participate if you want to as we go along here. But today, I'm going to just tell you another example about the deep economy at work. So just to catch you up, there's a sheep economy, probably where you're participating. You have a job, you have some credit, you may have an SBA loan, you're running a company, you've got employees, whatever it is you're doing is above the line. Because if you need capital to grow or run your company, or you need access to money quickly, or you just want to buy a house, buy a fleet of vehicles for your company, all kinds of different situations out there, who knows what you want to do, you would then have to go and get capital from some capital source, a bank, the SBA, some combination of bank, SBA, maybe some venture capital, an angel group, or if you're particularly sophisticated, from a private equity group. All retail sheep economy movements, even to go get money from venture capital or private equity. Okay, that capital is not easy to get. It is not fast to get. It is very consuming, and you haven't really, as you'll find when you get venture capital or private equity, you haven't really gotten money. You've taken a job that pays really well and is potentially worth a lot, but you work for someone else. All right, all sheep economy stuff. We're going to talk about how to reach into the deep economy this year, get into the flow of capital, get your soup ladle down in there and extract usable money from the deep layers of liquidity that function in the economy. So what is this deep economy? Way down at the bottom of the deep economy is the Fed discount window, which is the free money rate. That is where you get free money. What is free money? It's money you still have to pay the Fed for it, say 5.5%, but you could lend it out immediately for more than you bought it for. So that's the free money rate. There is money and liquidity. So I want to read you a quick article here and then comment on it that will show you that this deep economy really does exist and how the mechanisms function. Peter Johnson, you probably don't know him, founder of the consumer social website Polywork. In 2022, he raised $28 million from lots of well-known investors, one of them GitHub CEO Nat Friedman, many other investors. If you're in the venture market, you would recognize. What does Polywork do? Does it matter? Like connects people with blah and blah, like connecting people like LinkedIn, sits on top of LinkedIn and converts things and connects people, basically social network for prosumers, right? So a massive networking platform, right? It was announced that this company would shut down and return. So this is what's interesting about this deal. They returned 23 million of the 44 million it raised. So young guy raised $44 million from investors in, sounds like 2021. And in 24 returned 23 million of the 44 million raised from investors, which included Andreessen Horowitz, very hard firm to raise money from, great due diligence, knows what they're doing. Somehow they ended up giving this guy a ton of capital. So in an interview, Johnson said that the New York-based startup struggled to attract and retain enough consumers and customers after finding some initial success. So this is amazing. This is probably not the world you live in. You get $44 million. You try to do something. You recognize that thing is probably not working that well. People have their eyes all over you, and you decide to give half the money back, more than half the money. This realization is one, as the article said, that other startup founders have come to over the last 2 years. In fact, I know somebody who raised $5 million. They gave $2.5 million back to their investors when they found out that what they were trying to do wasn't going to work. So in particular, let's see, Lacework, same thing. Didn't find customers, couldn't find a economical way to acquire customers or charge those customers money, and basically couldn't get a spreadsheet or a model that shows eventually, if we continue to pour money into this, we're able to find enough customers, and those customers are willing to pay us of enough money that this would become a business. So abrupt shutdown of Level is another thing this article mentioned. Level raised millions from Lightspeed Venture Partners, Coastal Ventures, and others. These are all tier one firms that presumably know how to invest effectively. Very good reputations. So these companies all end up closing after they had tried to acquire customers, couldn't acquire customers, couldn't figure out how to grow the business, couldn't figure out how to charge customers, and also could not figure out how to sell the business at a profit, and so they ended up closing it. Another company, Bench, just closed. This is the Deadpool of Polywork, Level, and Bench. Shows that companies and investors are still working through the aftermath of the 21-22 cash capital bonanza, which included record equity funding and plentiful venture capital debt and loans tied to startups' ability to raise capital rather than traditional underwriting metrics like business cash flow. So when you hear that a business has raised $20 million, $25 million, $44 million, we tend to believe that somehow that is a measure of success. Raising capital is not a measure of success. Deploying that capital, obviously, in building a business is a measure of success. But too many people are running around saying we have raised money, or this business has raised money, or this business I'm involved in has raised money. That is not, in the traditional world that you come from, that can be a measure of success. Like companies raise money to grow, and they rarely screw that up when it's a real business. When there's no business and they raise money, they often screw it up. So I think there was some metrics here. But all of these guys, and very specifically the guy I started mentioning, and this is what I want to bring you down to. So whatever this guy's name is, I have to roll up to that. Peter Johnston. So Peter Johnston hasn't given up his startup dreams altogether. The entrepreneur moved to San Francisco late last year and is now starting a new company, Profile.com, which aims to use artificial intelligence to build more effective recruitment tool. So what is he doing? He's opening up the exact same company, but this time using AI. And so many levels that you could name. This is preposterous. This guy took $44 million, right? Couldn't get something going, had to give half the money back. But now what he realized is, and this is what's important here, there's an ecosystem in which money is available even to losers. And that is called Silicon Valley. Take $44 million, don't get something to work, lose $20 million of somebody's money. Now you can move deeper into that ecosystem and get funded again. So that is what happens. This is what happens when you know how to function in an ecosystem. Silicon Valley is an ecosystem. So this guy, let me scroll to the top again and get whatever his name was, Peter Johnston. I'm just trying not to remember his name because this is odious to me. There's an ecosystem where you can fail, but if you learn the language and if you learn the tools and if you learn the mechanics and if you know how to tap into the money part of that ecosystem, you can continually, and you learn the buzzwords, right? You continually extract capital out of that system until you're either completely banned from it because you've lost so much money like Theranos, or you've done something illegal, or you're successful in some way, or you start something and somebody else makes it successful for you. What are the tools in that ecosystem? You need a financial model. You need a pitch deck that looks like the Sequoia pitch deck. You need to have be in a buzzy part of the space that people are dumping money into. You need to have connections and networking because there's 1,500, 2,000 venture capital or venture capital-like money sources in the Silicon Valley Bay Area ecosystem. You need to know how to run around up there, get meetings, navigate those meetings, have a financial model, have conversion metrics, talk about marketing and advertising channels, talk about organic traffic, have a value proposition, and have a buzzword bingo or whatever the technology of the moment is, which obviously is AI. I need to have some experience in some vertical. So this guy's combining AI and LinkedIn, so artificial intelligence to build more recruitment tools. He's got a financial model, he's got a pitch deck, he's got networking, he's got some names attached to it somehow, and he's using that to tap into liquidity in the Bay Area. Will he be successful? Who knows? Maybe not. But the point is, if you have the tools to tap into streams of liquidity that is open to you. Now, should you run to the Bay Area and try and tap into liquidity there, even if you have those tools? My suggestion, we know for lots of reasons, we can discuss that somewhere else. But the point I want to take away, there is capital or liquidity or cash or whatever you want to call it, financing, funding, whatever term of art you use in your business, available to you in the deeper parts of the economy if you have the language and the tools available to you to tap that part of the economy. Those tools are available to you. Stick here in the Game of Money podcast, in which I'm covering the deep economy, but this is an example. You can go Google Peter Johnston. The company that he tried to build was called Polywork. Read the articles on him. A lot of them are behind paywalls, but hopefully you can find one on Business Insider or on Yahoo or something like that. And you'll see, took $44 million, gave $23 million back at it again by tapping into liquidity in Silicon Valley. What I like to show you is how to, over time of listening here, is how to tap into the liquid parts of the deep economy by using the tools that are available to you and I. That's been a quick review here today on the Game of Money. And if you have a chance, go buy another copy of Pitch Anything. You probably already have one if you're listening to this. Buy another copy, give it to a friend. That's what makes this available to you. And I'll see you next time. Deep Economy, Game of Money next week.